Okay, this is chapter 5, and chapter 5 today I'm going to talk about the merchandising operations. Let me share my screen. Start, start working on this. So the merchandising operations. Merchandising is the company. So in businesses, we already established that there are three types of businesses in North America in general. One is dealing with directly sales. One business dealing with the merchandising activities, operations, and the third one is the manufacturing company. Now, what's the difference? The difference is the inventory accounts that any of those businesses can have. Now, the service, if you're doing just service, probably you're not going to carry inventory account, or if you have some inventory account, that will be this. For the merchandising operation, obviously, in order to sell something, you have to purchase it. So whatever you purchase, that's what you can sell. So today we're going to see how we're going to do accounting for the merchandising companies. And the last thing that's going to that's going to leave, that will be the manufacturing company. Manufacturing company, if you take this managerial accounting course with me, we can talk about the manufacturing company. Manufacturing company and what's the cost there, what's involved there, and how we do costing for manufacturing company. But today, again, we're going to focus on the merchandising operations. Merchandising operations, again, uh, merchandising operation, company buying product, selling product. All the products are finished, those are complete products. We're not doing anything, we're not producing it, we're not improving it, we're just buying and selling. Period. So the merchandising entity obviously is going to run the revenue by selling products, which is called merchandising inventory. Or we can, for simplicity, we can just call it inventory. This is different from the selling services. On the services, we're just providing the services to the clients. The clients pay you, end of the story. There is no inventory passing from the seller to the buyer. So the merchandiser will have inventory account sitting on the balance sheet. Now from that inventory account, once the product is sold, we're going to get the sales. But sales always comes with cost. I want you to understand this logic now. If I want to if I want to sell a cup, I have to buy the cup. But that cup comes with cost. So if I pay $10 to buy a cup, and if I'm busy buying selling cups, always to be profitable, I have to sell it above my cost. So for that reason, it's imperative for me to know the cost of my inventory before I sell it. Make sense? Because if I don't know the cost of my inventory before I sell it, then I won't be able to generate any. In this case, that will be gross margin. So that's why in this case, we're going to have one inventory account on the balance sheet for where we're going to store our inventory for the time being until that inventory is sold to the customers. Once it's sold to the customers, we're going to have one transaction for the sales. We're going to have second transaction for the cost of goods sold or expense. And then we can calculate our gross margin, which is sales less cost of goods sold. Sales revenue, again, selling price of the merchandise sold by the business. That's why it's called sales revenue. Again, this will result in increase of the capital from delivering inventory to the customer. Every time when we give the inventory to the customers, that we're going to increase the wealth of the owner or equity or capital. So Unfortunately, that inventory that we sell to the customer comes with cost. And since we sell it, it's going to become a cost of goods sold. Why cost of goods sold? Because we just sold the goods. And that will be the major expense in the merchandising company, obviously. If you're running, let's say, a grocery store and your merchandise is of the groceries, your main expense will be the cost of the groceries, which will be the cost of goods sold or cost of sales. Once we sell it to the customers, until the inventory is held and kept by the seller, that will sit in the balance sheet, and that will be your inventory. When the inventory is sold, the cost become expensive. Simply, how can we say it simply? Once you go to McDonald's and buy coffee, until you open the lid, start drinking the coffee. That's your asset. Now, in this case, we're not going to sell the coffee to somebody else, but let's pretend we buy the coffee. That's your inventory. It will become expensive once you start using it. But let's pretend that you're buying the coffee and selling the coffee to somebody else. Once you sell it, that becomes cost of goods sold. Until you sold, sitting in your inventory as goods available for sale. So the gross margin is simply calculation between net sales and cost of goods sold. Once you hear the word net in front of something, net sales, net accounts receivables, net equipment, net machinery, net assets, means original minus something, less something. That means there's some deductions of something. Pure example you have for your payroll check. You see the gross amount, and at the bottom finish with the net amount. The one that you don't like, but the one that you only get. After all the deductions from the gross amount. In this case, we're going to work with the net sales. What that means that we're going to have a sales revenue, and then we're going to deduct the sales return and allowances and sales discounts. We're going to talk about today what's the sales return allowances, from where those coming, and what's the sales discount. Cost of goods sold will be the total of all the costs which are incurred to bring the assets to it intends to use, which in this case to be sold. All other expenses, like administrative expenses, like accounting expenses, those will be deducted from the gross margin if there's something. Remember, in order to generate gross margin, you have to sell above the cost. So you have to prepare these financial statements. Let's make it bigger so you can see it on the screen. If you have to prepare these financial statements for the service company, what we're going to have? Service revenue. Then we're going to have expenses, which will be the salary expenses, amortization expenses. That's all. But if we have a merchandising company, we're going to have a sales revenue. Then we're going to have cost of goods sold. Then we're going to see the gross margin. Every merchandiser wants to know how much generate from the main activity, which is buying and selling of the merchandise inventory. That's why we have the first calculation called gross margin. After that, the same person wants to see which are the operating expenses which are necessary to run my business, but not directly to the cost of the items that they sell. Then we're going to have those selling expenses and amortization expenses, and then we're going to have a net. On the balance sheet for the service company, again, we're going to have cash, we're going to have accounts receivable, we're going to have prepaid expenses. We might have some inventory, but that will be office supplies. office supplies, which we already know. At the end of the period, we're going to count them, we're going to see how much we use it, and we're going to expense them. For the merchandising company, we're going to have a separate inventory account. We'll do separate inventory account. We're going to have beginning balance, going to have the ending balance, and we're going to keep track of the cost of the inventory that we purchase it, so we can keep track of the cost of the goods sold once we sell them. Inventory. What's inventory? Business inventory includes all the goods that the company owns and expects to sell to customers. Obviously, once you open your business, you're not buying, let's say, yeah, I'm still gonna go with these cups. You're not buying cups because you like cups. If you like so much cups, you're not gonna open your business. You're gonna open a hobby. That will be a hobby, collecting cups. But if you open a business, you're buying cups and selling cups. So for that reason, the inventory that you have available, you expect to sell to the customer in the normal course of operation. Inventory obviously will be the asset which we will report it as current assets on the balance sheet. Now the question is, how much cost us our inventory? Well, the cost of our inventory will be the same again with the assets. That will be the calculation of all the costs which are incurred to bring the asset to the intended use, which for this situation for sale, less any discounts and attending amounts. For example, what is the cost incurred to bring the sleeping bag made in Asia to a store shelf in Toronto, which is ready for you to buy or somebody to buy? Well, in that case, we're going to have, let's make it bigger so you can see it, but obviously we have to do something. I have to do some adjustments here so you can actually see it. Like this, make it on bigger, it's not going to help us too much. But let's see how that. Now the cost of the sleeping bag is only one cost. Then we have to pay the custom dues, which is $5. Then we have to ship the sleeping bag from Asia all the way to Toronto. And during the shipping, we want to purchase the insurance. So all those costs which are related to the sleeping bag, which we needed in Toronto in order to sell it, it will be included in the cost of the sleeping bag. So the total cost of the sleeping bag in this case is not only the purchase price, but all the other costs which are going to bring the bag in the place that we want to sell it to the customer. All the costs up to that point will be cost of the inventory. In this case, $50 million. So, what's the operating cycle? Obviously, every merchandise, every person, or every individual, or every company which wants to start a merchandising business, the first thing that they need is cash. Then they're going to convert the cash into inventory. They're going to sell the inventory. Either they're going to get the cash right away, either that's going to become accounts receivables. And once you collect the accounts receivable, it's going to become cash. So this is the cycle of the cash: buying, selling, collecting, buying, selling, collecting. Now, what's going to happen within this process? The business usually is going to keep running the record of the inventory, cost of the goods sold, by updating the accounts for every time when we purchase something, every time when we sell something, and when we return, when the customer return whatever he doesn't like. Now, for that reason, we're going to have a perpetual inventory system. Now, it's very imperative for you to understand the perpetual system, because next time we're going to build how we're going to build on this, and we're going to calculate how we're going to get the cost of the good sold under the perpetual system. What is perpetual system first? Perpetual system is automatically updated system, which running constantly updated records from everything that you purchase and everything that you sell. That system even can catch how much is your gross margin right away. The example, perfect example will be, for example, let's say, imagine you go to Walmart, you like some item, you cannot find size medium. What you're gonna do? You're gonna go to the one at the store people, and you're gonna ask them, "Hey, can you tell me, please, do you have medium size of this item?" So what they're gonna do? The only thing that they have to do is they have those devices. They're gonna scan the barcode of the item, and they're gonna check the system, which is perpetual system, inventory system, which is going to give you, yes, in this item, I don't have anything in this store, but I have 2 items in Coquitlam store, 5 items in Langley store, and 1 item in Burnaby store. Do you want me to ship it here for you, or you want to go and pick it from there? That's perpetual system, which inventory system is automatically updated. Every transactions that happen. The transactions again can be purchase, sales, and return. That system is going to keep record of unit purchase, unit sold, and the quantity of the inventory on hand. As you can see here, we're not talking about cost. We talk about physical units which we have available for sale, physical unit that we actually sold, and the actual quantity that we have available on hand right at this moment. So, periodic system. That's the second system that you can run. Again, one is perpetual, the other one is periodic system. Periodic system. What's interesting in the periodic system? We're going to do, we're going to count the beginning inventory. At the end of the period, we're going to count, excuse me, the ending inventory. Then we're going to do something very simple. Since we have the beginning inventory, we're going to check our invoices for receipts for all the goods that we purchased during the period. Once we get the beginning inventory plus the purchases, cost of the goods that we purchased, is going to give us cost of goods available for sale. Once we deduct the ending balance, we're going to get the cost of goods sold. So this calculation is used by the company that cannot afford to run that perpetual system, which automatically updates itself for every purchase and every sales and every return. It's a simple system for the local grocery store where the father is the owner and the manager, mother is the purchase manager and the sales manager. The total is cashier and accountant. Inventory in this case is counted at least once a year. Most likely will be counted every month at the end of the month. And then we're going to prepare the financial statement. We're going to cover this periodic inventory system later today. So, perpetual, periodic. Perpetual keeps running records of all the inventory when it's bought, when it's sold, and when it's returned. Inventory is counted at least once a year. Periodic system, inventory system, doesn't keep those running records of all the goods bought, purchased, and all the goods sold. And we also count at least once a year. What we have to remember here is inventory is always counted at least once a year. Obviously, in periodic system more often than the perpetual system. So let's see what will be the accounting for the purchase and sell inventory under perpetual inventory system. Out of those two, first we're going to start talking about the perpetual inventory system, then we're going to move to the periodic inventory system. Let's deal with first with the perpetual inventory system. How are we going to keep track of the purchases, how are we going to keep track of the sales, and how we're going to keep track of the available quantity of the inventory that we have available. So, perpetual inventory system keep track of every piece of the merchandise that we purchase. Once we, in the cycle of the merchandising, obviously we're going to begin with the purchase the inventory. Imagine this company purchase inventory for $700 on account. Our general entry will be very simple: debit inventory, credit accounts payable, because it's on account, we're not paying cash. What do we need to know, and what do we need to have in order to make this transaction? We know we need to have the document which proves that the purchase has been made. That will be our, so in normal business, first we're going to have the purchase order. When the actual goods arrive, then we're going to have the invoice. Imagine this company, the buyer, will issue the purchase order. The seller, for the merchandising they wish to sell. I want to purchase this and this and this and this and this item. Now, the seller can tell you, I have this and this and this item available. I can send it right away. It's going to cost you, if you want 10 items, cost per item is that much, photo will be done. So, when the goods are delivered, the seller is going to issue invoice or bill to the buyer for the merchandising that's shipped. Now the invoice, the items on the invoice has to match the items on the purchase order. Usually the buyer already have from the seller unit price as well. So they can even match the unit price from the purchase order and the invoice. Invoice, they usually going to have seller's name, invoice date, purchaser's name and address, credit terms, available discount, item that has been ordered, corresponding price per unit, and invoice total. So, before we continue further, I want to make it clear. The price that we pay when we buy something is a mathematical function of two variables. Which are the variables? First is the number of units that we purchase, and the second is price per unit that we purchase. So if for coffee, for the medium coffee, you pay $1.25 without taxes, that's because you buy one coffee, and the cost for one coffee at McDonald's is $1. If you buy two coffees, you obviously have to pay $2.50 before taxes. And we can keep going. So as you can see, The total cost is always a mathematical function of two variables, which is number of units, cost per unit. Discount. Obviously, you may have a valuable discount. There are two major types of discounts. First is the quantity or volume discount. So more you buy, less I'm gonna sell you per price per unit. If you buy, usually some of the online stores, they have, if you buy first 100 items comes at that price. If you buy between 100 and 1,000 items, you're gonna get the price discount per piece. Second available discount will be the purchase or cash discount. That will be discount that you can deduct from the selling price if you pay earlier. Means that you may have a credit terms. Credit terms is stated in the expression as 2/10, comma, and /30. What that means? Means that if you pay within 10 days of the invoice date, you can enjoy 2% discount. Otherwise, you have to pay me within 30 days the amount that stays on the invoice. It's a bad example, but it's an example that I'm going to use. You can see this if you get a speed ticket or some parking ticket. Let's say you get a parking ticket. On the parking ticket, you can say you have the cost of the parking ticket is $70. If you pay within 14 days, you have to pay only $50. After 14 days, you have to pay the full amount. That's perfect example of the cash discount, purchase or cash discount. We encourage you to pay early. So, in our case, where the buyer bought from the seller inventory for $700, on the credit terms, so if the buyers pay within 15 days, can enjoy 2% discount. If it missed the 15 days point, there will be no discount, so the buyer has to pay the full amount of $700. Let's pretend that the sales happen on May 27. The buyer paying on June 10. How many days we have? Obviously May 27, May 28, May 29, May 30, May 31st. That's 5 days. And we have another 10 days, 15 days to June. So the buyer paying within the discount terms. For that reason, the buyer doesn't have to pay the full amount. They can enjoy 2% discount. 2% of $700, that's $14. So for that reason, the buyers don't have to pay $700. The buyer has to send a cash only check for $686. But the buyer closing accounts payable for $700. Now where the difference goes? The difference is going to go to the inventory account, which means going to reduce the cost of our inventory. So now our inventory is going to cost us $686, which will be $700 minus $14. Or, in other words, the inventory is going to cost us exactly the amount of the cash that we paid. As you can see, both the purchase and merchandising and the subsequent discount are recorded in the inventory account. Remember, for the perpetual inventory, purchase. And purchase discount, we record in the same account inventory. That's going to reduce the value of our inventory, and now our value of the inventory is $686, which is exactly the amount of the cash that we paid. Now let's go back again and pretend that the buyer now doesn't pay within the 15 days. He pay after the 15 days. In that case, the buyer has to pay the full amount of $700. So for that reason, the buyer is going to make a normal generating debit accounts payable, credit cash for $700 in this case. So in this case, as you can see, our inventory is going to be more expensive. It's going to be $700, not $686. That's a previous case. So what that means? That means if the seller give you a discount, take it. Just take it. Purchase return allowances. Now, it can happen in North America, it can happen everywhere. You already probably experienced that one. You're buying something, you don't like it, you're going back, and you can return it. Once you return it, you get a full refund. The other option is you're going there, you want it, you like it, but it's damaged. So you're asking for allowance. In that case, you keep the item, but they give you allowance, which is going to reduce the amount that you have to pay for the seller. So again, business allow customer to return unsuitable merchandise or damaged goods. If the buyer chooses to keep that goods, then allowance might be given. Both return allowances reduce the amount which we have to pay to our seller. And in both cases, we're going to reduce the inventory by crediting inventory account. How this is going to look like as a journal entry? Again, we purchased that inventory for $700, and obviously we didn't pay. That's why it's in the accounts payable. Now on June 3rd, remember we purchased it on May 27th. On June 3rd, we returned $450 inventory to the seller. Once we return that items to the seller, we don't have to pay for those. So we purchased 700, we return 450. Now we have to pay only $350. So what we're going to do? We're going to reduce our accounts payable, debit accounts payable. We're going to reduce our inventory. Why? Because once we ship it back to the seller, we don't have it in our inventory. Since we don't have it in our inventory and the seller has it back in his inventory, we're going to decrease our inventory and we're going to decrease our accounts payable. Imagine next day, we notice that one of the goods is a little bit damaged, but we want to keep it. We don't want to return it in this case. So we ask the seller, hey, can you give me some incentive? And the seller says, yes, I can give you allowance of $25. So $25, whatever you have to pay me. So at this point, we have to pay $350. Don't send me $350, send me $250 minus $25, which I give you as a purchase allowance for the slightly damaged goods. So our journal entry will be, again, we're going to reduce the cost of our inventory and we're going to reduce the accounts payable. That will be debit accounts payable and credit inventory for the $25 for purchase allowance. So where will be our inventory at this point? Original was 700. Then we return 450. Then we get allowance of 25. Our inventory, cost of our inventory right now is $225. Let's check for accounts payable. Initially, we have to pay $700. But since we do 450, we don't have to pay for those ones. So we have to pay only 250. But we also get allowance of $25. So we have to pay only 225. As you can see, inventory, cost of our inventory matching exactly accounts payable. Let's see the account for accounts payable. Now, let's see something else. What we're going to do for the transportation cost. Oh, obviously somebody has to pay for it. We're going to have two transportation freight costs. One will be the freight in, the other one will be freight out. Easy to remember is once you're buying, since we're in the, don't forget, we are in the merchandising business. So we're buying from the seller and selling to another buyer. So once we're buying inventory, which come into our hands, the freight is related to moving the inventory from the seller warehouse to our warehouse is called freight in. Once we're selling, inventory moves from our hands to the buyer hands. That will be our freight out. Again, freight in when we're purchasing, freight out is when we sell. Freight in cost are included in the value of the inventory. So every time when we pay freight when we're purchasing, we're just adjusting our inventory cost. Now, for the transfer of the ownership of the goods, we have two different events. First one is the free on board specified. Free on board, FOB. Every time when you see FOB related to merchandising inventory, that's related to the free on board. And that specify that the legal rights when those legal rights passing from the seller to the buyer. And that determines who has to pay for the freight. The other option that we have to have now the free on board. So now we have two events: free on board shipping point and free on board destination. Now let's summarize it before it becomes too complicated. First, we have freight in, freight out. It's delivery related to the purchase, and the second one is the delivery related to sales. Then we have point at which the goods are transferred from the buyer to the seller, which is called free on board. And we have two different free on board situations. First one is free on board shipping point, and the second one is the free on board destination. Free on board shipping point means that the title and or the ownership of the inventory passes from the seller to the buyer when the inventory leaves the seller's place of business. At that point, the buyer owns the goods, and obviously he has to pay for the rent, plus the insurance, plus everything which is related from shipping the goods from the buyer's seller's warehouse to the buyer's warehouse. Second available option is free on-board destination means that the rights of the goods passing from the seller to the buyer when the goods reach the buyer destination. Example, imagine you order pizza Domino from your home. One option is to be free on board at the shipping port. What that means is once the pizza leaves the pizza Domino place where the pizza is made, you have to take care of the delivery. So, if the delivery guy trip and fall down and drop your pizza, that's your pizza. You have to deal with that drop pizza. But if you have a second scenario, which is free on board destination, then you have the pizza at the time when the pizza comes to your house. You open the box, check the pizza, say, yes, this is the pizza that I ordered. Then become your pizza. Which one you prefer? Obviously, you prefer the second one. In that case, if the delivery guy dropped the pizza somewhere on the way from Domino place to your house, it's his responsibility for the pizza. So you don't have to worry about delivery in this case. Make sense? So now what you're trying to do, if you're in the merchandising business, what you might have to try to do, you get the seller to pay for the freight in and get the buyer to pay for the freight out. Which means that when you're buying, you have the scenario when you're free on board destination. And when you're selling, you're going to have free on board shipping point. In that case, you're free of delivery cost. Now let's see the journal entries related to the freight or transportation cost. Imagine this company that they bought those $700 inventory. They have to bring the inventory from the seller warehouse to their own warehouse. How can they do that? By paying for the freight. And unfortunately for them, that was free on board the shipping port. So they have to pay for the freight. In that case, what's going to happen? The cost of the inventory is going to go up with the cost of the shipping, which is $100 in this case. And obviously, once the shipping company delivers the goods, you cannot pay on account, you have to pay cash. So for that reason, we're going to increase the cost of inventory, debit inventory $100, and we're going to reduce our cash with $100, and we're done. So what's going to happen in that case with our inventory? First, remember, we purchased for 700, then we return for 150, then we get allowance for $25, and the last thing that we did, we paid freight $100. What's the cost of our inventory at this point? $325. Now, if we have to do the summary of the inventory cost, the summary always going to be purchase inventory minus purchase and allowances minus purchase discount plus the freight. It's going to give us the inventory cost or net purchases. So all these things gonna be keep track from our perpetual system. So we don't have to keep manual records. Everything is once the transaction is posted in the system automatically updates itself. So we're gonna have the purchases, we're gonna have the returns, we're gonna have the allowances, we're gonna have the freight. We're gonna have it. That's for when we purchase the inventory. Now let's see what's going to happen if we have to sell the inventory. First, we're not going to keep this inventory forever, right? It's boring going to have inventory, only buying inventory. Why do we need that inventory for? We don't need it. So what we have to do, we have to sell it. So once we sell the inventory, we're going to generate sales revenue. Now the question is, once you generate sales revenue, what do you want? Do you want cash or do you want the accounts receivables? Most likely, you want cash. Okay, so what will be the general entry? Debit. Cash, credit, sales revenue. But hold on a second. How about the inventory that we just sold? Do we have to update our inventory records? Yes, we do. So what we have to do? We have to reduce our inventory. But reducing our inventory, we have to debit some account. Which account we're gonna debit? We're gonna debit account, income statement account, which is called cost of goods sold. So we're going to have debit cost of goods sold, credit inventory for the number of the items that we just sold, and cost per unit, total cost. And at that point, first, cash goes up for the sales price that we're charging the client. Inventory goes down for the cost of the goods that we just sold. On the income statement, we're going to have our sales revenue. And right after the sales revenue, we're going to have the cost of goods sold. So we can see our gross margin right at the point of sale. What I want you to remember is at the point of sales, the true transaction that happens. Every time when you go to the store, imagine, let's say, superstore, and you purchase something, let's say a bottle of juice or a bottle of Pepsi. Once you slide the bottom through the scanner, the two transactions happen right at this moment. First transaction to show the amount that you owe and the sales price that they're selling to you. And the second transaction is, which you don't see there, what happened in the system, is reducing the inventory of the Pepsi Core bottles with one bottle and showing the matching the cost of the goods that was just sold. So we can see the gross margin right at this point. So once we're selling, we may experience, since we're the one that we're selling now, once we're selling, we may have sales return. The client doesn't like the buyer, sorry, the buyer. We are not now, we are the seller. The buyer, yes, the buyer doesn't like our items, he can return them. We're going to give them sales return. The buyer likes our item, wants to keep it, but they're damaged. In that case, we can give them sales allowance. We may want to speed up our accounts receivables by giving them the cash terms. That will be the sales discount. And we might have to pay the freight out expenses, which will be free on board destination. So what will be the example first? Let's pretend that this company has 60,000 inventory on hand. They have. They're selling for cash 10,000 of that inventory, and the cost of goods sold plus 6,000. So what they're gonna do? Debit cash, great, sales revenue 10,000. Then they have to reduce the inventory, but they have to show the cost of goods sold. Debit cost of goods sold 6,000, credit inventory 6,000. Now at this point, if they have to prepare the income statement, they're gonna see that they have sales 10,000 with the cost of goods sold 6,000. The gross margin at this point is $4,000. Right there. Cash increased with 10,000. Inventory is reduced by 6,000. 4,000 revenue is going to show increase in the equity, or eventually it's going to go to the owner's capital. Now, let's go with this one. Now, on June 10, this company sells 24,000 on account to the buyer, which the cost of goods sold are $14,400. What that means? That means that we have to prepare two entries. First, debit accounts receivable, since we're not collecting cash. Credit sales revenue, 24,000, 24,000. And then we have to show the cost of goods sold and reduce our inventory for the amount of the cost of the goods we just sold. So that will be 14,400 debit cost of goods sold, and credit inventory to reduce the inventory with 14,400. At this point, we can see how much exactly is our gross margin, and it should be $9,600 right there. Now, the next part, which is interesting, is we receive some cash on June 31st. So what we're going to do? We're going to get the cash, debit cash, and we're going to reduce our accounts receivables with $5,000. So instead of we need to collect 24, now we need to collect only 19,000. Why? Because of July 31st, we collected 5 of those 24,000. Later on, the customer may have some sales return, or we can give them sales allowance, or we can give them something else. Sales discounts, sales return, and allowances are deducted from the sales revenue. However, they're recorded in the separate accounts. Remember this. Sales return, sales allowances, sales discounts are separate accounts, which are contra accounts to sales revenue. On the income statement, you don't have to show them if you don't want to show them, but you have to put net sales, which will be the sales revenue less sales return and allowances less sales discount. And you want to show net sales revenue or net sales, just as it says. So let's see now an example. Remember, in the beginning, we sold inventory for $24,000, which costs us $14,000. We generate $9,600 revenue. However, On July 2nd, the buyer came to us and said, you know what? Goods that I don't like, doesn't meet the specification. I'm returning those ones. Cost me $3,000. I'm sending it back to you. Now what we have to do? We have to get those units back to us. So that means our inventory is going to go up, but not with the price that we sell it to the buyer. That will come to us as the original cost, which is only $1,800. So what we're going to do? First, we're going to reduce the sales, reduce the accounts receivables for the $3,000. Debit, sales return allowances. Again, that's a contra account to the sales revenue. The contra account means the opposite side of the sales revenue. As you remember, revenue is always on the credit. Now, sales return allowances also on the debit side. And we're reducing our accounts receivables with the $3,000 on the credit side. But buyer sent us that inventory as well. Now we have the inventory back, so we have to adjust our inventory, but for the original cost. So that what will be that? Debit inventory for 1,800, and we're going to reduce cost of goods sold 1,000. In that case, our accounts receivable is going to go down. Our gross margin also is going to go down. So, on July 15th, the buyer called us and told us that they're damaged goods, but he wants to keep that goods. The buyer wants to keep that goods. He asking for allowance, and we decided to give them $500 allowance. So what that means? That means that his accounts receivable is going to go down. So our accounts receivables or his accounts payable is going to go down with an additional $500. But we have to show it somewhere on our records. What will be that? That will be our contra account to the sales revenue, which is the sales return allowances with $500. So what's happened with the accounts receivable at this point? First, we have to collect $24,000, but the client returned $3,000. Inventory for $3,000 that we sold. That's the reduction accounts receivable of $3,000. Plus, we give the client $500 allowance, which brings accounts receivable for this particular client to $20,500. So let's pretend that we also offer a discount, class discount. So if he pay within 15 days, we're going to give him 2% discount. If he missed that point, he has to pay within 30 days with no discount. He calls the timing for the discount. So does he has to pay 20,500? No. How much he has to pay? 20,500 minus 2% on that amount, which is $410. $205 and $205, $410. So we're gonna receive a check for $20,090. We're gonna close the accounts receivables for $20,500, and we're gonna debit sales discount, which is again contra account to the sales for $410. What's happened with our sales? No, first let's see the accounts receivables. In the accounts receivables, we started with 24,000. We received return for 3,000. We give allowance for 500, and the client used the 3% discount of $410. So that was the 400, but we closed the accounts receivable $20,500. So accounts receivables is gone. On the sales side, we're going to have sales for 24,000 less sales return allowances for 3,000, less sales return allowances for 500, and less sales discounts for $410. So net sales will be 24 minus all those amounts, or the exactly cash that we receive, which is $20,500. Now we know how to account for the events which happen in the merchandising company, which running perpetual inventory system. We know how to deal with the purchases when we purchase the merchandising, and we know how to deal with the sales when we sell this merchandising. We know when we purchase how to deal with the purchase return allowances, purchase discounts, and freight in. And now we know how to deal with the sales return allowances, and sales discounts. Now let's see, the next thing that we have to do is adjusting closed accounts on the merchandising business on the perpetual inventory system. Remember, at the end of the period, we have to close all the revenue accounts and expense accounts. Where? In the income summary account. But now we're going to have a new account. We're going to have sales return, we're going to have sales allowances, and we're going to have the sales discounts. And we have to adjust for all those three. So that means we have to close those accounts. Plus, we have to close cost of goods sold. Now, first, for adjusting inventory based on the physical count, let's see how we're going to adjust the inventory based on the physical count. Remember, at the end of the period, at the end of the year, we have to manually count the inventory. Imagine, in our system shows that we have to have on hand inventory for $174,000. We count our inventory and we found that we have only $168,000. Inventory for $168,000. So we're missing inventory for $6,000. What shall we do? Well, obviously, we have to reduce our inventory for those $6,000. If we reduce the inventory, we have to increase something. What we're going to increase? Cost of goods sold. So what will be the entry? Debit cost of goods sold with $6,000. Credit inventory with $6,000. And we are adjusting our inventory for the missing $6,000 inventory that we have. After that, we can start closing accounts. First step, we're going to close revenue accounts into income summary account. No questions about it. Second, we're going to closing the expense account into income summary account. Remember, revenue goes credit on the income summary, expenses goes on the debit side on the income summary. Then we have to close all the contra accounts that we just created. Sales discounts, sales return allowances. But their balance will be debit. So we have to credit them. If we credit them, we have to debit income summary account. And then we have to close it, cost of goods sold. Cost of goods sold, normal balance will be debit. So we have to credit that one. If we credit cost of goods sold, we have to debit some account. Which account we're going to debit? Income summary account. Then we're going to check what's happened in the income summary, and we're going to close income summary account into the capital account. The last thing that left, normal closing entry, is to close the withdrawal account. Example will be here. Closing entry is going to include the debit sales revenue, debit interest revenue, credit income summary. Then we do debit income summary, we're going to create cost of goods sold, sales discounts, sales return allowances, and operating expenses. Then we're going to check income summary credit side and income summary debit side. And we're going to see that we need on the debit side $932,000. That drags the credit to the capital for the same amount. The last thing that left to do is to closing the withdrawals account. Once we do that, our job is done. So what that's happened is the income summary account is closed, withdrawal account is closed, and in the capital, this person, he has balance of $157,000. Now we have to prepare a financial statement for that perpetual inventory system. How we can do that? Income statement. From the income statement, we're going to have operating expenses for all the expenses that are not part of the normal operating activities, but are related to the fact that we're doing business. Income statement, we will report those operating expenses two categories: selling expenses and general expenses. Then we're going to have that gross margin minus operating expenses, going to give us the income from operations. Then we're going to have other revenue expenses, and after that we're going to have a net income. Example of those revenue expenses, which included the gain and losses, interest revenue, interest expenses, and the two basic formats of the income statement: multi-step and single step. Multi-step is when we have different calculations. First, we start with the sales. Make it bigger so we can see it. First, we start with the sales, then deducting sales discounts, sales return, and allowances, and we come up with the net sales. Then we're deducting cost of goods sold, and we're coming up with the gross margin. After that, we're deducting the operating expenses, we're going to come up with the income from the operations. Then we're going to add or deduct other revenue or other expenses, and that's how we're going to come up with the net income. Single step. In the single step, we're still going to have net sales. Then we're going to show the revenue. So we're going to group them only revenue and expenses. We're going to have the total revenue, we're going to have total expenses, and we're going to have net income. One thing that I want you to know is that we cannot change the net income. We can present it different ways, but that income is always going to stay $132,000 regardless of which format we're using, single step or multiple step. Owner's equity, beginning balance of the owner's equity plus the net income minus withdrawals of the owners is going to give us owner's capital at the end of the period. Once we have the owner's capital at the end of the period, we can prepare the balance sheet. Balance sheet is going to have the current assets, long-term assets, and total assets. Liabilities, current liability, long-term liability, total liabilities, owner's equity, or only the capital account, which comes from the statement of owner's equity, 157. 157 is going to come here on the balance sheet, and total liability and owner's equity. Our job is done. So, one more thing. We know how to deal with the perpetual system. We know what to do with the purchases. We know what to do with the sales. We know at the end of the period how to close, which account we have to close. The new accounts that we have to close, which is the contra account to the sales revenue, which is the sales return in analysis. Then we have to close the sales discounts. Then we have to close the cost of goods sold, and our job is done. Prepare the financial statements, multiple step or single step income statement, depends what you want, and we're done. Now let's see how we're going to evaluate the business. We can evaluate the business by the gross margin percentage and the inventory turnover. Let's see what's the first one. Gross margin percentage. Gross margin percentage is simply gross margin divided by the net sales. That's going to give you how much of the sales stays in the company after we deduct cost of goods sold. If the gross margin here says 43.9%, that means for every dollar of sales, 43.9 cents stays in the company. Gross margin is the first important checkpoint for the companies when they start preparing their financial statements, because it's indication how well the company managing the costs first, sales, and how much they can generate from selling inventory and merchandising inventory. This is important measure of profitability for the business, for production line, for product, for simple division or anything like that. Next one is inventory turnover. Now, the inventory turnover is calculated a little bit more difficult. I mean, it's not difficult. You just have to follow the calculation. The calculation is cost of goods sold is your nominator, and average inventory is your denominator. What that means? Average inventory means beginning inventory plus the ending inventory divided by a few. Once we get cost of goods sold as a numerator and the average inventory as a denominator, we're going to get a number, simple number. Now the question is, where do we want that number? Do we want it high or we want it low? And what means if the number is high? What means the number is low? Again, at this point, it's just a number. Now we have to do some interpretation of that number to see, is it in our best interest or not, what that number is. Because at this point, it's just a number. So now, inventory turnover will be as a number of days, will be more meaningful number. So what we have to do, whatever you're calculating inventory turnover by dividing cost of goods sold divided by average inventory, then we're going to get the 365, which is the number of days of the year, divided by that number is going to give us how many days takes us to sell our inventory. Now, in this case, as you can see, if the inventory turnover is 2.6, means transfer to 140 days. 140 days, it might be a good number of days if we're selling mining equipment. But if we're selling simply flowers, or if we're working as a bakery store, if our inventory turnover is 140 days, then we are in big trouble. What that means, we prefer the higher rate of turnover. So every business has to be looked separately to see what the inventory turnover is and what that inventory turnover means for that business. Now, International Financial Reporting Standards. Those are the differences between the accounting style of the private enterprises and inventory International Financial Reporting Standards. I'm going to leave it to you to see those one and to read it by yourself. And probably here is the best time to make a short break, and then we can continue with the same thing, purchasing and selling on the periodic inventory system. So let's see how we're going to deal with the periodic inventory system. How we're going to track the purchases, how we're going to track sales, and how we're going to find out how much is our cost of goods sold, and is there any difference between this periodic inventory system and perpetual inventory system. First thing first, it's very important you to understand how we're going to calculate cost of goods sold, because for the periodic system we have to calculate cost of goods sold. That is not automatically calculated from our perpetual system because we don't have it. We have to do it manually. So how are we going to calculate? We're going to get the beginning inventory. Then we're going to get the net purchases. Means that we're going to get the purchases, we're going to get the purchase discounts, we're going to get the purchase return allowances. We're going to deduct those one from the purchases, and we're going to get the net purchases. Once we get the net purchases, we're going to add the freight in, and that's how we're going to get cost of goods available for sale. At the end of the period, once we do the inventory count, we're going to see how much is our ending inventory. And once we deduct from the cost of goods available for sale the inventory, we're going to get the cost of goods sold. And that's how it's going to be. Now, inventory in the periodic system is not adjusted after each transaction. We're going to rely only on this calculation, including the end inventory on the physical inventory count to compute the cost of goods sold. Inventory is not tracked by the system. So we have to do this, everything we have to do it manually. Let's start one after now. Now, first on the perpetual system inventory, purchases, purchase discount, everything is part of the inventory. In the periodic system, that's not the case. For everything, we're going to have a separate account. Purchases, we're going to keep it in account purchases. Purchase discounts, we're going to keep it account purchase discounts. Purchase return allowances, we're going to keep it in purchase return allowances account. Transportation cost, we're going to record it in freighting account. And once we get the purchase minus purchase discounts minus purchase return, we're going to get the net purchases. Then we're going to add the freighting, and we're going to get everything that we purchased during the period. Let's see the example here. Let's use the same example that we purchased 700 inventory on account. So what we have, debit purchases, credit accounts payable. As you can see, the difference between this and the other one is that in the previous case, we debited the inventory account. Now we're debiting separate account. Purchases and creating accounts payable. Next, let's pretend that the client we're giving the same term, 2% if the payment is made within 15 days, and no discount if the payment is made after the 15 days, but it has to be made within the 30 days. So in that case, we're still going to close the accounts payable for the entire amount, $700. We're going to send the check for $686. But now we're going to open a new account, which is purchase discount. Again, as you can see here, the purchase discount doesn't go to inventory account, it goes to separate account, which is called purchase discount. In the periodic system, we're not using inventory account. We're creating for everything, we're creating separate account. For the purchases, purchase account. For the purchase discount account. Later on, we returning $450 goods. Well, that's going to reduce our accounts payable, $450, and it's going to create a new account, which is purchase return allowances, $450. Once we receive the allowance for $25, that's going to further reduce our accounts payable with $25. And we're going to have a new account. We're going to put those $25 in the purchase return and allowance account. So we're increasing that amount of the purchase return and allowance account. The freight that we have to pay, the freight is going to go to the separate account, which is freighting account. So that will be, for the freighting, there will be no difference between, actually there will be difference, because in the previous one and the periodic perpetual system, we debited into inventory. In this case, we debited in the freight in account. And we create cash. In both cases, we paid cash. So, to summarize what we have here, the new accounts that we have, when we purchase something, we adding everything in the purchase account. When we have the purchase discount is going to purchase discount account on the credit side, which is contra account to the purchases. When we have a return and allowance, we put everything on the credit side in the purchase return allowance. When we have, that's for return, first is for return, second is for the allowance. When we have the allowance, again, we put it in the allowance, purchase return allowance account. The last new account that we open, which is not inventory again, is the freight in account. So we open purchases, purchase discount account, purchase return allowance account, and the freight in account. That's when we purchase it. Now let's see what's going to happen when we sell it. When we sell it on the periodic system, it's a little bit more easier. Why? Because at the time of the sale, we don't have to record the cost of the goods sold. Why? Because they're not available. They'll be available at the end of the period. As we remember in the very beginning, we're going to calculate that cost of goods sold at the end of the period. How? Beginning balance plus the purchases minus the purchase return allowances minus purchase discount plus freighted cost of goods available for sale. We're going to count the ending balance and we're going to get cost of goods sold. So once we sell $3,000 sales on credit to customers, we're going to debit accounts receivables for $3,000 and we're going to create sales revenue for $3,000. Again, cost of goods sold would not be involved in this at this point. How are we going to compute again cost of goods sold? The one that I showed you, that I told you like a few seconds ago. Beginning inventory, which is the ending inventory of the previous period, which we already counted. Then we're going to add the net purchases. Now the net purchases, including the purchase of inventory, which is separate account, purchase discounts, less purchase discounts, which is separate account, and purchase return and allowances, which is also separate account. That's going to give us net purchases. We're going to add the freight in, and we're going to get the cost of goods available to sell. Once we deduct the ending inventory, we're going to get the cost of goods sold. That's another calculation of the same diagram. Here is more detail. I strongly suggest you to copy these slides for yourself and have it available all the time until you get comfortable how to calculate this cost of goods sold. On the income statement presentation, if we have to make comparison between perpetual and periodic system, as you can see, we're going to have the sales revenue, sales discounts, sales return allowances, which are going to give us the net sales. And then we have to calculate the cost of goods sold, which cost of goods sold will be complex calculation between beginning inventory, purchases, less purchase discounts. Let me make it a little bit bigger so you can see it. Purchase discount, purchase return allowances, net purchases. We're going to add the freight in. We're going to get the cost of goods available for sale. Once we count the ending inventory, we're going to deduct the ending inventory, and that's going to give us the cost of goods sold. Once we have the cost of goods sold, net sales minus cost of goods sold is going to give us gross margin. It's very straightforward. The only thing that I want you to know is to keep in mind this calculation here and to have it all the time with you. especially when we're dealing with the periodic inventory. Now, the last thing that we have to do is to adjust and close the accounts of the merchandising business under that periodic inventory system. So all the new accounts that we created, purchase return allowances, purchase discounts, freighting, we have to close those accounts. Plus, we have to close the sales return allowances, and sales discounts, which we are similar with the perpetual system. So the only difference that we have between perpetual and periodic is for the purchases under periodic and perpetual. For the sales, there's no difference. So the new accounts again are purchases, which have debit balance, purchase return allowances, which have credit balance, purchase discounts have credit balance. These accounts must be closed. The other thing that is tricky here is after we do close those accounts, revenue and expenses to debit and credit accounts, which are temporary accounts, we have to close those ones. At the end, we have to close the beginning inventory and open the ending inventory, which will be given to us. So we're going to start with the debit revenue account and all the contra expense account by creating income summary. Then we're going to debit the income summary and we're going to create all the expenses and contra revenue accounts. Then we're going to debit the income summary for the beginning inventory balance, and we're going to create the income summary to debit the ending inventory balance. After that, we're going to close the income summary account. And the last thing that's going to be left is to close the withdrawals into the capital. This question on the periodic inventory system, this type of question, you have to expect on the final exam. But the good thing is that we're gonna practice for this. So you don't have to worry about it. There'll be a package with the recording, which will be posted for you for the final exam. How are we going to prepare the financial statement on the periodic system? There's no difference. The only thing again is the calculation of the cost of goods sold. We have to go through this calculation: beginning balance, purchases, less purchase discount, purchase allowances, net purchases, freighting, available, minus ending balance, cost of goods sold. And then we're going to get everything else. That net income is going to go to the capital account or statement of owner's equity. Once we get the statement of owner's equity, once we get the owner's capital, that capital is going to go into the equity section. And that's owner capital. Assets are assets, liability are liability. Once we get everything, we should be balanced. For the next learning, perpetual versus compare perpetual versus periodic system. Again, the difference is on the purchases. On the perpetual, we debit and credit inventory. In the periodic, we debit purchases and credit purchase return, purchase allowances, and everything else. Also, at the point of sale, we calculate, on the perpetual system, we're recording the cost of goods sold to reduce the inventory. Where in the periodic system, we're doing this at the end of the period once we calculated the cost of goods sold. And the last one is a tricky one. is at the closing entries. We have to close the ending balance at the beginning balance of the inventory and open the ending balance in the inventory by working with the income summary account. Those are the main differences between perpetual and periodic system. Now that brings us to the end of the chapter. But again, I want we to spend a little bit time on the questions.